Hello, I'm Ken Carpenter, and welcome to Invest AI Savvy, where AI powers smart investing. Today, we're going to talk about stocks, bonds, ETFs, and mutual funds. Are you feeling overwhelmed by all the investing jargons? What does it all mean? Well, today in this video, we're going to demystify these terms and make them plainly understandable for someone that's new to investing. At Invest AI Savvy, we use artificial intelligence tools like ChatGPT and Gemini to demystify investments, make better investment decisions. Today, we're kicking off step one of my AI Money Mentor method, giving you clarity on your investment options so you can build a confident future without all the Wall Street smoke and mirrors. Let's start with stocks. When you buy a stock or several shares of a stock, you literally become a partial owner of that company. You're buying a small piece of equity in that company, which entitles you to certain rights and responsibilities. Now, the pros to buying stocks are the potential for high growth, voting rights, and maybe even dividends. Now, the cons are that the price can go down, you can lose your investment, and when the investment price of the stock, and when the stock price goes up or down, you can feel a little bit unsure if you made the right decision. So sometimes investing in a stock is not an ideal idea if you might need the money back soon in the future and can't wait for the volatility ups and downs to level out over time. Now, if you want to ask ChatGPT to give a little bit more deeper explanation, here's a potential prompt you could use. Act like my financial mentor. Explain what meanings. Act like my financial mentor. Explain to me what owning a share of Apple means in simple terms. Next up are bonds, also known as fixed income investments. Think of a bond as a loan you give a company or a government. In return, they pay you back with interest. Pros: steady income and generally less risky than bonds. Cons: lower returns and sensitive to inflation and rising interest rates. A sample ChatGPT prompt to investigate bonds further might be: explain to me why bonds are more appropriate for a retiree than owning stocks. Now let's move on to mutual funds. Everybody's heard of mutual funds, unless you've never heard of mutual funds. Mutual funds are a basket of stocks or bonds or other types of investments that are professionally managed in most instances and have a little bit higher annual management fee than if you had an ETF or exchange traded fund. When you buy a mutual fund, you're buying a slice of a whole portfolio of stocks or bonds, meaning that you're instantly diversified. So the pros to owning mutual funds might be that they're professionally managed and that you're instantly diversified when you own a mutual fund. Now, the cons to owning mutual funds could be that there's a higher annual management fee, number one. Number two, you're not going to get the high appreciation potential that you would with owning a single share of or a single company shares in stocks. And also you have less control over the investment. You can only buy or sell it. You can't really change the mix of the stocks or bonds that are inside a mutual fund. Now, one ChatGPT prompt that might help you learn better about mutual funds would be: explain to me the difference between an aggressive mutual fund and a conservative mutual fund, and explain the risks and rewards of owning either one. Please explain the risks in plain English that a layperson could understand. Now, next, we're going to talk about exchange traded funds, or ETFs. Now, ETFs are a little bit different than mutual funds because they trade like stocks do, meaning that an ETF can trade higher or lower than its net asset value. An ETF is a basket of stocks or bonds that doesn't change over time, meaning a professional manager isn't changing the asset allocation or the different stocks inside of it. Once an ETF is created, all the assets inside the ETF stay the same. The reason that ETFs are sometimes recommended over mutual funds is because they have a lower annual management fee and they can sometimes trade for less than their net asset value, meaning that you could buy a share of the ETF and it would actually be selling for less than the net asset value of the underlying investments inside of it. So you could find bargains with ETFs. Now, a con of owning an ETF is that the price can fluctuate a lot faster up and down than a regular mutual fund could. ETFs are still tied to market risk. A sample ChatGPT prompt for an ETF might be, what are 3 beginner-friendly ETFs that would be appropriate for a retirement portfolio? So between all these stocks, bonds, mutual funds, ETFs, how do you make a decision? That's where the AI Money Mentor method shines. Step 1 was clarity, and now you have it. Stocks give you growth, bonds give you stability, mutual funds give you simplicity, ETFs give you flexibility. Most smart retirement portfolios blend all 4 together based on your goals, risk tolerance, and time frame. A sample ChatGPT prompt to learn more might be, based on my retirement timeline and risk tolerance, help me create a retirement portfolio of stocks, bonds, mutual funds, and ETFs. If you found this helpful, I've got something for you. Download the free AI Money Mentor Starter Kit. 7 ChatGPT prompts to clarify your goals and avoid common retirement traps. No jargon, no pressure. Just click on the description below or more and see the link for the free download. And subscribe to Invest AI Savvy for weekly tips on using AI to take control of your financial future. Thanks for watching Invest AI Savvy. I'm Ken Carpenter, and that's the way it is.